Okay, imagine launching a financial product that is so incredibly successful, its own massive returns end up quietly killing it. Sound crazy? Well, since November 2015, gold prices have absolutely skyrocketed, driving a massive 180+% spike in appreciation. And, while that sounds like a total dream for anyone holding the asset, it actually created this unsustainable nightmare for the government's absolute best investment scheme.
To put that into perspective, we are talking about a staggering scale here. Over 72,000 crore rupees. That was the size of the Sovereign Gold Bond Program, or SGBs, which swelled to just massive proportions across its various series. The deal was honestly almost too good. The government had to pay out that 180+% gold price appreciation when people redeemed, and on top of all that, they were paying investors a guaranteed 2.5% annual interest. Eventually, the math simply stopped working. The government just couldn't afford it anymore.
So welcome to today's explainer. If you've been scratching your head wondering why you haven't seen a new sovereign gold bond issue lately, trust me, you are not alone. SGB issuances have suddenly and very quietly just stopped. It's left millions of current bondholders and prospective investors completely in the dark. So today we're going to break down exactly what happened behind the scenes and, much more importantly, what you need to do right now to protect your wealth and optimize your taxes.
Here is a quick look at our roadmap for this explainer. We'll cover the end of SGBs, the rules for existing holders, a really interesting NRI loophole, the absolute best gold alternatives out there today, and finally, some FAQ and myth-busting.
Okay, let's dive right into this. Section 1, the end of SGBs, and exactly why the government pulled the plug. To really figure out what you should do with your portfolio right now, we first have to understand why the most popular gold vehicle in the country basically vanished from the 2024 budget. Going back to November 2015, the government launched SGBs at roughly 2,684 rupees per gram. Now, keep in mind, India imports about 85 to 90% of its gold. We consume around 700 to 800 tons a year. That's a massive drain. The SGB was this brilliant tool designed to curb that physical import demand and keep capital inside the financial system. But fast forward to early 2024, with gold surging to the 75 to 80,000 rupee range for 10 grams, an internal review reportedly flagged SGBs as a highly costly borrowing instrument. By the time the union budget for 2024-2025 rolled around, zero allocation for new SGBs. The plug was pulled, literally without any grand announcement.
Moving on to Section 2, rules for existing holders. Let's talk about navigating maturity versus a premature exit. Listen up, because this is a really high-stakes situation. Millions of Indians are holding bonds that are going to mature on a rolling basis between 2024 and 2031. If you're one of them, how you choose to exit your investment entirely dictates your tax bill. And this brilliantly illustrates the critical choice you face. If you just wait it out and hold your bond for the full 8-year maturity period, your capital gains tax is absolutely zero. Zero. It's completely exempt under Section 47 VIC of the Income Tax Act. You get all that massive appreciation of gold completely tax-free. Conversely, if you get impatient and make a premature exit on the exchange after 5 years, your gains are fully taxable as long-term capital gains. The financial difference between patiently holding to maturity versus selling early is massive, guys.
But actually, scratch that. We need to bust a massive myth right here. A lot of people think SGBs are entirely tax-free across the board. They are definitely not. While the capital gains at the 8-year maturity are exempt, that 2.5% interest you receive semi-annually is a whole different story. That interest falls directly under the definition of income from other sources. What does that mean? It means it's taxed at your applicable income tax slab rate every single year. So if you're in the 30% bracket, you are paying 30% on that interest. You absolutely must account for this when you're calculating your true net returns.
All right, Section 3, the NRI SGB loophole. Let's look at how non-resident Indians can actually still get in on the action. We get asked about this constantly. Many non-resident Indians really want exposure to Indian gold assets, but they feel totally locked out by the regulations. So this brings us to a burning question. Can NRIs still buy sovereign gold bonds today, even with primary issuances halted? You might think the answer is a hard no, but there is actually this fascinating regulatory nuance, a loophole, really, that is very poorly understood. So the crucial point is this. While FEMA rules strictly bar NRIs from directly subscribing to new SGB issues, the secondary market on the National Stock Exchange and the Bombay Stock Exchange is perfectly legally open. NRIs can absolutely buy existing SGBs on the secondary market using their NRE or NRO DMAT accounts. It's totally fine.
If an NRI buys them there or just holds bonds from back when they were a resident, the maturity proceeds are simply credited to their NRO account subject to standard repatriation limits. It's a fantastic backdoor option.
Let's jump to Section 4, the best gold alternatives. Where exactly should you park your money now that fresh SGBs are off the table?
If you missed out on the SGB golden era, or you just have fresh capital you want to allocate to gold right now, you need a highly efficient modern alternative. Now, what's really interesting about this slide is how a clear new winner emerges: gold ETFs. Look at those costs. They have an incredibly low annual expense ratio of just 0.10 to 0.20%. Plus, their liquidity is exceptionally high because they trade directly on the exchange. Compare that to physical gold, where you have to deal with annoying storage costs, insurance, and just medium liquidity. Or even a gold fund of funds, which carries slightly higher costs. Without that 2.5% interest of new SGBs to rely on, the low friction and pure transparency of the gold ETF make it the undisputed smartest choice for post-2024 investors.
Let's move to our final segment, Section 5, FAQs and myth-busting. Let's clear up the remaining confusion floating around out there. We're going to run through a rapid-fire sequence here to address the most common anxieties investors are facing regarding their SGB holdings. First up, a major misconception. When people model their wealth, they usually just assume compounding, right? So, does that 2.5% SGB interest compound over your 8-year holding period?
The hard truth? No, it absolutely does not. SGB pays simple interest. It's calculated at 2.5% per annum strictly on the nominal value, meaning your initial subscription price, and it's paid out semi-annually, straight into your bank account. It does not compound back into the bond. Knowing this is absolutely vital for accurately calculating what your net returns will actually look like.
Next question. And man, this one causes a lot of panic. You log into your DMAT account, you look at your SGB ticker, and you see it priced noticeably lower than the current market rate for physical gold. You're thinking, what's going on? Why is it trading at a discount?
Well, the answer is extremely low liquidity. Because most investors are smartly holding on to their bonds to get that tax-free maturity after 8 years, there are barely any buyers and sellers on the exchange. If you find yourself forced to sell early on the secondary market, you almost always have to take a haircut, accepting a discounted price, just to find someone willing to buy it. This really drives home the advice we discussed earlier. Unless it is an absolute, unavoidable emergency, waiting for that 8-year auto-redemption is hands down the smartest financial play you can make.
Which brings us to our final thought. The landscape of gold investment in India has just fundamentally shifted. The SGB era was beautiful while it lasted, right? Unbeatable tax benefits, guaranteed interest. But with SGBs gone, will gold ETFs truly become the undisputed king of Indian portfolios? Or, considering India's massive 800-ton annual gold appetite, will the government eventually be forced to introduce an entirely new digital gold standard to keep all that capital from flowing out of the country? It is a fascinating space to watch, and understanding these exact mechanics is your first step to staying ahead of the curve. Thanks so much for joining me on this explainer, and as always, keep learning.